Hi, ladies and gentlemen. My name is Rudyard Griffiths, and it's my pleasure to be your moderator today. Let me introduce, of course, our stalwart friend, our guide, our sage, the ever-wise David Rosenberg, who obviously is going to be one of our panelists today. David, please say hello to your audience.
Good morning, everybody. Hope you're all well and healthy and safe.
Likewise. And look, our guest today is someone who I've been looking forward to talking to for weeks as soon as I heard that he was going to come on the Rosenberg Research webinar. His name is Felix Zulauf. He's the president of Zulauf Asset Management, a Switzerland-based hedge fund, which he founded in 1990. He now runs it as a private office of his own. Felix started his investment career at the Swiss Bank, then training in research and portfolio management in New York, Zurich, and Paris. He joined UBS, the Union Bank of Switzerland, in 1977, ultimately becoming the head of institutional portfolio management and global strategist for the UBS group. He's joining us today from Zurich, where markets are closed, Felix. So how was the day over there in Switzerland? Say hello to our audience.
Hello to everyone from Switzerland. It's cold and snowy here, but we have a lot to talk about that are different topics.
Right. And maybe just to have Dave express to us why he wanted Felix on these webinars. David, what were you hoping to provide your clients with by having Felix's advice and input for us today?
Well, you know, I have been following Felix for decades, and if you recall, he was a prominent member of the Barron's Roundtable. I would say that, and he might blush when I say this, but I used to only just read what he had to say in the excerpts. So, you know, whether we agreed or disagreed over the decades, and I'm pretty sure that I got to know Felix before he got to know me. We have both met at John Malden's conferences over the years, and I would just say that. I wanted to kick off the year with a voice of reason, a rational voice. I mean, you said before, I think you used the word in all this insanity. So I thought actually, not that I predicted all the insanity we're going to be having, but I thought I wanted to get a voice of reason and rationality into the mix. And there's really nobody I know in the business that can do it as well as Felix. So, you know, hence the great timing for this call.
Yeah. So Felix, it is the start of 2021, and I thought it would be interesting for our audience to just get a sense of you of the year ahead. What are you looking for to try to understand where finance, investing, macroeconomics is headed? What are the key signals that you're trying to pull out of the noise to advise your clients?
Okay, let me first step back a little bit to give you the framework in which we have to see the year 21. This is a very unique situation we have really hardly ever seen in history. We have a situation where interest rates are at 0 or below, where debt excesses are bigger than ever, and where central banks can really not help the economies anymore. That's really unique. Secondly, we have a very large and growing rift in the Western world between the haves and the have-nots. And that rift is growing bigger. And I have not seen it and experienced it personally, but from the history books I know, when this happens, you have the stuff for social revolutions. And the third item is that we have the Thucydides trap. That's when a dominating hegemon in power, a superpower like the US, is extended, mature, is weakening, and is getting challenged by a rising new superpower or a new power, which is China. and that usually creates problems and conflicts, which usually start first in trade, and then they could be political, geopolitical, and military also in the sense. So this is a powder keg of things that really frames our time, and this is compounded by very bad demographics in our societies, not just in the Western societies, but also in China, with population growth declining sharply. The US is the best of the industrialized nations with 0.5% growth, but the growth rate declining. Europe is hardly above zero, and the trend is declining. China is at zero and declining. Japan is at negative rates and declining, and economic growth is the result of population growth and productivity growth. And productivity growth is depressed because we have never seen as many zombie companies that reduce productivity in our system. The recent number we have seen in the US is about 15% of all the corporations are zombie companies. They do not earn the true capital cost. And in Europe, I think the number is closer to 20%. So this is a very challenging situation. And I think our decision makers are somewhat lost of what to do. And now they bring on the big cannons, which is fiscal policy in huge amounts, huge amounts. So far, the fiscal support has been a support and not a stimulus, because in most countries, it has simply replaced income lost. But I think going forward, it will be much bigger, and it will grow bigger to support the economies. So what I do see is, with the vaccination, there is going to be a certain normalization process in our economies, let's say from mid-year onwards. And as that arrives, we will have a pop for several quarters that the growth rates will go above the secular trends. But this is temporary. This could last into late 22 or something like that. And with that comes a pop in inflation, and with that comes a pop in long-term bond yields. The short rates will stay low, of course. The central banks will make sure. So a pop in inflation, which could be up to 3% or something like that. I do believe that at some point this year, the Fed, which is the most important central bank, will begin to verbally taper monetary policy. And probably sometimes next year, they will try to taper if the economic numbers come through as I expect. If that happens, we have a classic business cycle, which will be short, but the classic sequence. And we have a classic bull market cycle, which started in spring, in March of 2020. And in my view, is the last cycle in the secular bull run from the 2009 low. So I do believe that either in late 21 or in the first half of 22, this bull cycle in equities will come to an end and give way to a bear market that will go deeper than average. That's a 22, 24 story. An average bear market is mid 30% or so. I think it could be closer to 50. And I do believe that the big debate between value, cyclicals, and growth and defensives will really play out during the next bear market in a big way. When growth stocks decline sharply, we have another NASDAQ debacle in the next bear market. Right now, they are the thematic leaders. They are not outperforming anymore. They are slightly or marginally underperforming. I think they are in the early stage of a major top. And I cannot tell you whether the top is going to a gentle top building process into the first half of next year with a slightly higher highs from here on, or whether it will be a blow-off peak which would come sooner and will come this year. Either way, I think we are in for markets that requires trading capabilities, and investors have to be very shrewd because the whole situation is changing. There is no bond manager that has not lived through every bond manager has lived through bull markets only. They do not know what the bear market in bonds is. And I think the secular bear market in bonds is beginning. Once we break the 3% in the 10-year, which could be 22 or so, then really the problems start from there on. And I think most equity managers only know bull markets too, because it's been a run since the 1980s, early 1980s, and we had a few cycles in the 2000 area, 2000 to 2003 or 2009, where it was a little bit rough, but bear market expertise is precious, and I don't think a lot of that is around. So this year it's still bull market action. I think the best part of the bull market in equities is most likely already behind us from the low in March of last year, but there will be an upward bias with medium-term swings, probably a high February or March or so, and then a decline, a medium-term decline, and then up again. And depending on how that decline, the first decline is, we can better judge whether it's going to be a blow-off type of top or a more gentle process. If it's a shallow correction, it will look more like a blow-off top, and then the top will arrive sooner. That's in a nutshell what I see. I also see, maybe briefly, what has started in March of last year is the beginning of a secular bull market in commodities, and not because I see huge infrastructure projects. There will be large infrastructure projects, but nothing of the kind that we have seen in China in the previous decade, in 2000, 2015 or so. But I do believe that the Chinese, instead of buying treasuries, they will recycle their surpluses into commodities from here on, because they do not feel safe in US treasuries anymore. And I think that's important. So whenever the price is correct a little bit, they use their surpluses to buy and stock commodities, all sorts of commodities, from oil to food to base metals, everything. So I think commodities is a place to be for the longer term, for this decade, most likely. I do also believe that the dollar has started a secular bear market again from the recent highs, from the highs of March. The first down leg is close to over. It's not quite over yet, but it's close to over. We will probably see some counter trend activities over the year, but from next year on, I think the dollar goes down into the second down leg, etc., and that will fuel the inflation, nourish the inflation uptrend that we have. The Asian currencies will be the strongest currencies, and import prices from Asian goods will go up, which is different from anything we have seen in the previous decade since China was integrated in the world economy. So that swing factor is very important, because import prices are about 1/3 of your CPI index.
Felix, let me stop you there, because that is just a terrific banquet of ideas for us to get into with our Rosenberg Research clients who are sending in questions now. We're going to certainly get to as many of those questions as we can in the next hour. We'll be taking this webinar up to 12 p.m. Eastern. But first, I want to come to David before going to questions. And maybe, David, you could just pull out one or two key things that you heard there. Let's not say one, let's say a couple things you heard from Felix that you have a strong conviction about, David, either in disagreement with Felix or affirming his view. I just think it'd be interesting to see where you two guys meet up and where you diverge.
Right. Well, I mean, look, a lot on the Thucydides trap and the geopolitics, and I think that the biggest geopolitical challenge for the new administration is less about Iran and really more about China's economic ascendancy as it continues to grab an ever greater share of global GDP and global exports. So this is a different threat than a nuclear threat with the Soviet Union. But this is the first time in everybody's lives that we've seen the economic hegemony of the United States being challenged. And so it'll be interesting to see how the Biden administration deals with that. And other geopolitics, for example, we've seen what China has done in Hong Kong. Will the US continue to draw a line in the sand when it comes to Taiwan? So these are things we have to keep in the back of our mind, and why I always say in the portfolio, you want to have some insurance policy against things. If anything can upset the apple cart, certainly geopolitics is one of them. You know, and I also agree with Felix on that whatever normal that we're going to be seeing post-pandemic, it's really going to be a new normal. And I don't think that we can lose sight of the fact that we went into this pandemic with over half of the households in America at a time of full employment didn't even have enough cash or liquidity or savings on hand to get through 3 months of vital economic activity. We've done a lot of work on this. I would say that the most important behavioral aggregate that comes out of the national accounts data is this arcane statistic called the personal savings rate. There is nothing more behavioral than making your decision within the family budget, how much is going into spending and how much is going into savings. So we can talk about fiscal stimulus all we want, but the decision to save rather than spend is very critical. And the work we did showed that if the pre-pandemic normalized equilibrium savings rate was 7%, it's going to be, in our work, at least 3 percentage points higher post-pandemic. It doesn't mean that we're not all going to run to the restaurants and the bars and go fly. I don't think that's what they call pent-up demand, which it really isn't, but that rush of euphoria is really not something you're going to capitalize over a period of years. It's really a couple of quarters. And then reality is going to set in. And we don't know really how people are going to respond to the trauma. We have been in shock. Maybe we don't realize it. We have been in an economic shock months and quarters, and it could end up being another year of isolation, social distancing. And I think this is why I finally get why when you take your economics degree in university, they make you take psychology and sociology, because it's a study of human behavior. And historians will write, and sociologists and psychologists will write about the post-pandemic trauma. It doesn't tell me we're going to be seeing a big spending binge. I think it's going to be a culture of frugality and savings post the pandemic once we all get inoculated. Let me just go to the one area maybe of disagreement, which is on inflation. And I want to take people back to 2009, 2010. For years, we had Ben Bernanke and his band of merry men interventionists with repeated quantitative easings, repeated boost to the money supply. We started off that cycle with gargantuan fiscal stimulus in the name of the Reinvestment and Reconstruction Act from Barack Obama back in 2009, back when $600 billion actually meant something. And then we finished off the cycle with those epic tax cuts from Donald Trump. And I remember so many people, I remember watching Larry Lindsay, who knows interest rates better than Larry Lindsay? He was on the Fed as governor. I remember seeing him saying that bond yields are going to go to 5 or 6%. This is actually back after Trump got elected. We were going to get the big reflation. We got the tax cuts. We went into 2020 with $1 trillion deficit, biggest deficit in peacetime periods. Where was the inflation? Where was the inflation? To me, we got to go back to that last cycle. That last cycle from 2009 to the beginning of 2020, we have to use that as a template. We have to use that as a template. And I think that people get lulled into this view that because the stock market went up fivefold, we had a tremendous economy in our hands. And of course, Donald Trump really promulgated that myth. We had a powerful bull market in the context of the weakest economic expansion of all time. In fact, the economic expansion from 2009 to 2019 was weaker than we had from 1932 to 1937. And of course, people draw that conclusion because people think the stock market is the economy. Well, it's not. And what happened from 2009 to 2019 that accounted for a very large chunk of that bull market was nothing more than financial engineering in the form of the biggest debt for equity swap of all time, as companies issued gobs of debt to buy back their stock. And it was the dramatic, unprecedented decline in the share count of the S&P that caused half the bull market was right there, had nothing to do with the economy. So I come back to the last cycle because, you know, we had Jay Powell take over the Fed in 2018. He comes in, guns a-blazing, he's going to normalize interest rates. At his Senate confirmation in the beginning of 2018, all Jay Powell talked about was normalizing interest rates, and normalizing interest rates in Fed parlance back then was 3%. We're going to 3%. And then he raises rates in October 2018, raises rates again December 2018 in the middle of a market maelstrom, threatens to do more, the market goes down 20%, credit spreads blow out, and he does the Powell pivot. Nobody ever talks about why did we get the Powell pivot 50 basis points shy of what they were telling us normal was. People are telling me we're going to go back to normal. Well, let me get this straight. The Fed told you 2018 we're going to normalize interest rates, but they never could because they couldn't normalize interest rates into an abnormal economy. And we haven't had a normal economy in decades. We have an economy every cycle that's built on asset inflation as opposed to productivity and on tremendous amounts of leverage. And that's a situation. We actually, in the context, think about it. For all the talk about the inflation, before the pandemic, where was the Fed funds rate? 175. Where was the 10-year no yield? 2%? It was less than 2%. Where was the big inflation? Where's the big inflation going to be in the next 10 years? Within more of an aging society, which means more savings, less discretionary spending, more debt. We can talk about technological advance. We can talk about these gaping extreme income inequalities, which is a pervasive constraint on growth. But here's the big deal. The big deal is we are choking on too much debt. That's why interest rates can't go up. If we get interest rates going up, and I got to tell you something, by the way, 3% inflation is not going to be enough to reflate our way out of this. People seem to think that we'll have a natural reflation default. Well, what happened in the last cycle that wouldn't accomplish it in the next cycle? We had basically tremendous monetary policy ease up in 2015. We had 2 rounds of massive fiscal stimulus, both in spending and tax cuts, that took the deficit to $1 trillion. We had full employment. We had 300% unemployment. We had real interest rates at 0. And then for a lot of that cycle, they were negative. Where was the big inflation? Like, where's the template? Like, and I understand that it's a forecast.
Dude, let's have Felix come back on this.
But I'm just going to get to the crescendo here. Okay. People are wondering, and I've been writing about it, why hasn't 25% money supply growth created the inflation? And here's the answer: because money velocity is going down pound for pound. And that's what I'm trying to say, is that we have too much debt. The credit multiplier is broken, and it's showing up in a pervasive decline in money velocity. MV equals PY. Inflation is actually not an opinion. It's not a narrative. It's an accounting identity. The Fisherian accounting identity, the quantity theory of money, MV equals PY. And what's interesting is that the New York Fed actually produced a report that showed that 3/4 of all this stimulus, if you want to call it, it's really income replacement. 3/4 of it, and you'll see this in the $2,000 checks. I assume we're going to see that. 3/4 are not even going into the economy. 1 quarter is. 1 quarter, and that's the 1 quarter that's going to people that actually need the money, and it's going into food, and it's going into rent, and it's going into utilities. And then the other 75% is either going into savings, today that means Robinhood accounts, and debt pay down. Debt pay down. Like you see in the result of the pandemic has been that credit card outstandings in the banking system is down to its lowest level in 3 years. How unpatriotic is that? That households in America are cutting up their credit cards. So I don't think you can get inflation unless you start to get money velocity picking up. But you see, you're not going to get money velocity picking up until we redress this massive debt burden, and we're just adding to it. So basically what I'm saying is that, and this is where I'll disagree with Felix, is I think that we're following Japan. Europe followed Japan, now we're following Europe on the way to Japan, and I don't see 3% inflation or 3% bond yields in Japan, but that's the road that we're already on.
Okay, let's have Felix come back on this. Give us your counter argument here, and then audience, we're going to go to your questions for the balance of our hour together. But I think this is a fascinating conversation. Inflation, I think, is the issue that investors who want a macro view have to wrap our heads around. So to have these two counterpoints from David and Felix is a real privilege indeed. So Felix, let's hear your rebuttal of David's skepticism about the possibility of rising sustained inflation.
Well, I agree with most points that David makes, and I have been a deflationist from very early on. I was buying the first zero coupon 20-year US Treasury bonds in 1981. I was the first buyer at the UBS sales desk at that time, and I've been riding the bond market down to these levels. Now, what I'm talking about is cyclical inflation, not secular inflation. The cyclical inflation will come in due to import prices, not so much domestic prices, import prices. If I'm right about the US dollar, then let's say 4 or 5 years from now, we will see the US dollar index at perhaps 70 compared to 90 today, or maybe even somewhat lower. And most of the move, and the bigger move it will most likely have against the Asian currencies. And Asia is the manufacturer of the world. And therefore, Asian prices in US dollars will go up every year. In the past 20 years, Asian import prices from Asia went down and subtracted about 1% of CPI inflation in the US. Now you swing that around and you add 1% every year, and it makes a different story. You have a somewhat higher level. That's one point. And the other point is that in demographics, we could run the risk of a shortage of labor in certain industries because the youngsters are getting fewer and fewer, and therefore there could be in certain industries a shortage, and wages in those industries could go up. And those are my arguments that why it could go up. And then it's cyclical. I'm saying it goes to about 3% probably sometimes in the second half of this year, which is not much. We are at 1.4 or something like that right now. So this is not much. It's a double from current levels. And then it may come down again. But I think the major impact on inflation will come through the currency impact over the next few years. That is my, and primarily from Asia, much less so from Europe, because they have much bigger problems with their currency.
Felix, just talk to us a little bit though. You're explaining a world that seems to function and react and respond to real market forces. And I think if anything we've seen over the last decade, and especially over the last 9 to 10 months, is the willingness for governments and particularly central banks to intervene. So talk to us a little bit more about why you think I assume from your thesis that the central banks are increasingly out of firepower, and that their ability to intervene going forward, say through something like yield curve control, is not something that you're factoring into your analysis. Because I think a lot of investors, myself included, are kind of intimidated right now by the known unknown, which is the immense power of these institutions and their seeming willingness to intervene in the market in ways that were just unprecedented, even in the last decade, in terms of what we've seen in the last 9 to 10 months.
Well, central banks will play an important role to finance all the debt out there. I do believe that central bank balance sheets will continue to grow sharply over the next 10 years, sharply. It could, I could see the Fed balance sheet at 40 trillion 10 years from now, easily. I agree with David that the money multiplier is not there. It's not working because of what he described, that people become frugal and thrifty, and they save more because they have to. They have no other choice. When you have interest rates at zero, you have to save more for your retirement period. That is very simple. Central banks will finance all the debt there will be by the governments. And I just tell you, the green wave that we have right now, everybody in politics today is green, and we looked at the projects out there in the world that governments have already spoken the amount for, that is for climate protection or climate improvement or whatever you call it. That number altogether on the globe is double of what all the government major projects were in human history, including the highways of the US, including the Chinese wall and what have you. This is mind-boggling. We have gone, I'm also in favor of protecting the environment and taking care of the planet, but what is coming is just insane. It's just insane because if you do not do it, you're a bad human. You see, that's the driving force here. And I think that could add to GDP. Whether it will add to productivity is another question, because probably half of what they spend will be malinvestments. It is very similar to what the Chinese have been doing. They pumped up GDP growth, but actually the productivity of the economy in many ways has really not been there. So I think this is important. It will support the economy, but it will not make it more productive and more prosperous. Right. And I think it has to be financed, and it must be financed by central banks, because the governments are virtually bankrupt, and they are bankrupting themselves. And when you are of low credit quality, the borrower has to pay a premium. It's as simple as that. I'm very concerned about France in Europe. I'm more concerned about France than I am about Italy.
Interesting.
France and Germany had about the same amount of debt, non-financial debt, outstanding when they created the euro. Today, Germany, or actually by the middle of last year, Germany was at 192 and France was at 398, very close to Japan. And I think they have no other choice than try to create inflation. Whatever it costs, they will try. And because growing out of the problem is not possible, and going the restructuring way is so painful because it ruins the system. The banks own the debt, the insurance companies own the debt, etc., etc. The pension funds own the debt. They ruin the system. So they will try whatever it needs. They will try to do so. And I think the U.S. is in is entering the same territory, coming into the same situation. So they will try. And as market participants, investors realize that credit quality of those governments is going down, they will begin to step away from it. And then you have a rising yield, not because of inflation, but because of declining credit quality. And that's what I see coming.
Wow. Okay, let's get to some audience questions here. I'm conscious we've got about 25 minutes left of our hour together. We're taking this call up to 12 p.m. Eastern. Felix is joining us from Zurich, so we appreciate that. David and myself here in Toronto. Bruce is asking, Bruce James is asking you both. Let me go to you first, David. Where are you suggesting that people be invested roughly? Can you give us can you give Bruce some broad allocations here? And he's asking, importantly, what is your cash position at this point? David, you recently wrote a column that touched on that last part of Bruce's query to you. Let's have your answer.
Well, look, firstly, I don't make it a career or a habit to tell people what to do. I just tell people what it is I'm doing, and you can choose whether you want to follow or not, okay? I mean, I would say that I'd probably be 20%. I mean, I'm 20% cash right now. You know why? You know why? Because I want to buy the dip. I hear about buy the dip. It's one of those great, it's like fear of missing out and don't fight the Fed, these wonderful refrains people make up. Buy the dip. I want to buy the dip. If you don't have cash, what are you going to buy the dip with? Unless you sell off other assets or you leverage up. So I think cash right now, although idle cash is not earning you anything, you know, with the excessive multiples that we're seeing right now, the unbelievable tight spreads we have in the credit market, I would say that looking at valuations, generally speaking, cash, I think, looks pretty good. Although it doesn't earn anything, it's going to give you the optionality. In terms of ideas, because I'm not going to give allocations, because part of the allocation would be long-short strategies. I'm a big fan of hedge funds that actually do hedge. And so long-short funds, I think you should have in the portfolio as a stabilizer. I think that we're in a bog of uncertainty. I know the markets believe that we're going to have a big recovery. And maybe we'll have a recovery for a period of time. I'm not going to rule that out. But I don't want to buy sectors that are single idea, that rely on how behavior is going to change after we all get inoculated. So I'm not out there running to buy airline stocks, okay? I'm not out there running to buy casinos or theme parks. Or anything that you would say, well, this is going to happen. This is pent-up demand. I don't believe in the pent-up demand story. And I wrote about it today in Breakfast with Dave. It's ridiculous to talk about pent-up demand in consumer cyclical services because the haircuts that we didn't get last year, you're not going to replace those. So I would say that if I want to play the recovery, what do I want to do? I want to play it in a prudent, diversified way. So I like the financials. The financials are cheap. They're well capitalized. You can argue, well, is there going to be regulatory risk with the new administration? Well, regional banks have less of that. But the banks are a great diversified way to play any sort of recovery. Well, that's how I'm expressing it. Energy, I mean, Felix talked about the commodity complex. The one that I like the most, I like oil and I like natural gas. And I like natural gas more than just about the polar vortex. Natural gas prices are up 20% this year. Everybody's focused on Bitcoin and the S&P. Nobody knows the natural gas prices are up 20%. But you see, natural gas, LNG, I think that if you're actually in the clean energy mold, and I think we all are, well, natural gas is a natural play into that. But I think we have something else, which is that as oil prices crossed about $50, the Saudis gave us a lot of information that they have once again reclaimed ownership as the marginal producer. They're cutting output 1 million barrels a day next month and the month after, not at a time when oil prices were going down. This wasn't to support or put a floor under a bear market. it was actually to ratify a new higher range on the oil price. So if the E&P stocks are priced for $35, $40 oil, and the Saudis have put a floor under the price at 50, I think energy stocks actually have quite a bit of visibility. So those are areas that I like, and I would still say, look, this whole debate, value against growth, growth against value, why is it one against the other? I actually continue to like companies in the growth sphere, and this would include big cap staples with brand names, and it would include big tech, I would say, at better valuations. But I think we came out of this deep recession, unstable recovery, pandemic, looking at companies that made money. Look at companies that made money. There are companies that made money in the worst, in a period of human misery. Now look, the equity market is a commentary on human behavior as it pertains to the market. That's why it's not a moral compass. Why wouldn't you buy? I mean, these companies have been re-rated. Companies in big tech, and not all of them, but the ones that have utility-like characteristics. And what am I saying? You want to own companies that you use every single day. You make up your mind which companies you use every single day. I'm not just talking about eating Campbell soup, okay? There are areas of big tech we use every single day, and we could argue their stocks are too expensive, so wait till we get better pricing points. But I would say that growth stocks that have utility or essential characteristics coming out of the pandemic, you want to have that in your portfolio. Outside of that, and I 100% on board with Felix, that you want to go to Asia. We have to always have a GARP mentality, growth at a reasonable price. The only area of the markets globally that actually give you that, the only markets that give you growth at a reasonable price is in Asia. And so those are the markets that we're concentrating on right now, especially Southeast Asia. I think that that's something as well that Felix said in his opening remarks. On top of that, and this might be the one area where Felix and I might disagree, I should throw gold in there. Gold. I still like gold. We can talk about gold versus Bitcoin. I don't even want to talk about gold versus Bitcoin because I don't even think that's any more of an appropriate comparison than comparing consumer staples with financials. You know, maybe there are surrogate currencies. Their properties are so different, it's a ridiculous comparison, but people like to make it. But I would say that with this latest run up in bond yields, you know, with the long bond yield at 1.8% is trading like a high yield bond in the sphere of the global market for sovereign debt. The treasuries are trading like high yield in their specific space. I know that sounds ridiculous, but actually what's interesting is that the long bond yield, the 1.8%, is actually a higher than the average yield you get in the entire corporate bond market. The corporate bond market does have default risk. Think what you want about treasuries, they don't really have default risk. So I would say that, and our proprietary work is showing actually that it's flashing a green signal right now for duration. So the long bond's looking very attractive right now in our work.
Great, sorry about that. I was just running low on battery. It's one of the occupational hazards of these types of events. So appreciate your patience with me. So Felix, similar question for you. What are you looking at in terms of allocation, big themes that you would recommend to investors, and is cash part of that strategy?
Well, the way I run my own money, and I don't run any outside money. I only run my own money, and we are consultants and not as managers of outside people's money. We use 5 pillars, and those 5 pillars are equities, fixed income, commercial real estate, commodities, primarily gold, and then a trading pillar, which is primarily foreign exchange and foreign exchange trading. So I can tell you that I'm about average for my equity pillar, about neutral right now, or slightly above neutral, because I think this is going to be a trading year, and I will do more of this in my trading pillar. I have a bias towards Asia, South Korea, Taiwan, and Japan. And I have a bias towards commodity-related equities, base metal producers and traders like Glencore, and luxury accessories, growth stocks of luxury accessories, those French ones, and things like that. That's my equity bias. Southeast Asia, a little bit of Europe. In Europe, I own some financials, primarily insurance, because they are cheap, and with rising bond yields, they are doing better, particularly in the life insurance portion. And in the property and casualty, I see that the cost ratios are going down tremendously. So I like those. In the fixed income portfolio, private debt dominates over listed debt, because in private debt I can get very high single to low double-digit returns. Of course, you run a higher risk. You are locked in usually for 2 or 3 years. Sometimes I do deals that are shorter, 6 months or 12 months or so. And you have to do the credit analysis more carefully because you're locked in. Then the commodity sector is primarily gold bullion. I like bullion. And then I also own some gold mining stocks. I do believe that gold is in a sideways trading range for the next 12 months. So I see the upside at a little bit over 2,000 and the downside at 1,700. And we move in back and forth here as a pause after the huge run-up that we have seen from 1,200 to over 2,000. I think it needs a rest, and it builds a springboard for next year where it goes higher. And I do believe that gold will be a lot higher by the end of this decade. So I like that a lot. In foreign exchange, I don't have any trading positions on right now because the dollar is extreme on the downside. It's very oversold, and the Asian currencies I like the best are very overbought. So when I see those situations, I usually exit. And my hunch is that I will trade more this year in equities, and I will buy medium-term corrections in equities and in commodities. Those are the two themes. I like energy a lot. I expect the oil price by early next year to trade, let's say, near $70 or so, which makes for very good runs in some of the conventional oil company stocks that you have with very decent yields. So that makes a lot of sense to me. I also own a lot of technology stocks, but I'm much lighter than I used to be in technology. And usually the thematic leaders run into the last week of the bull market. They do not cave in before, so they will participate, but I think the big money will be made on the downside. I have made a lot of money in every bear cycle, so I think the next big hit that that I will do in the market is really on the downside when I see the NASDAQ topping. That's coming late this year or early next.
Felix, talk to us a bit about the French franc. We had a question from a Rosenberg research subscriber just asking your views on the Swiss franc.
Well, the Swiss franc is fundamentally very strong. It has very large chronic current account surpluses because our fathers and grandfathers invested overseas, and we have the constant flow back of dividends, earnings, and interest income from all over the world into Switzerland, which creates chronic demand for Swiss francs. And the problem is that our economy is highly export oriented. 2/3 of our GDP is exports, and and half of those exports are to the EU, the Eurozone. And therefore, it's important that our currency does not move too far away from the euro. And that's the big problem. And therefore, our central bank is really creating a lot of Swiss francs to throw into the market to keep the Swiss franc from strengthening further and further. The US Treasury call them a currency manipulator, but actually the Swiss franc is very overvalued against virtually all other currencies. And it's just our solid situation. And I think our central bank should let the currency go, but not in full, in a managed way. And I think that's what they are going to do in the future, that the Swiss franc will constantly revalue against the euro, but the euro is such a bad currency that it's not an anchor I like, you see? It's just a given situation due to the economic setup. So I hope that over the years, our dependency, which is clearly visible already against the EU, declines and goes up against other economies like Asia, India, China, etc., and the US. And therefore, we could then have a better revaluation. But for the time being, it's a managed currency with a slight tilt to the upside against the euro. And I would not recommend to invest in the euro. The euro is a misconstruction from A to Z, and the monetary union is terrible. It weakens the strongest, and it really doesn't help the weakest because it prevents them from reforming and biting the bullet. And therefore, Europe is in a constant relative decline and will disappoint economically over this decade tremendously. And they have made now the mistake to start the fiscal union with the recovery fund, mutualization of debt. All that will weaken Germany dramatically. And the German chancellor has given in to the French, and the EU model is a French model, and the EU economy will become more French. And the euro is not the Deutschmark, but it is basically the average of the Italian lira and the French franc, which were two terrible currencies. Yeah. So this is the European situation. I can see that there are some excellent companies in Europe that will perform well as long as the bull market runs. But in general, I would rather prefer Asia over Europe.
Just in our remaining moments, David, 6 minutes or so on the clock, I want to squeeze in one more question, which I think gets at a big question that's on everybody's minds right now, is what happens if the 10-year Treasury continues its journey up from here? And this viewer is asking, you know, what is the Fed response? When does the Fed, have a concern about those rising yields? What could it do in response to them, and what could the impact be on equity markets?
Well, I mean, so far, the Fed hasn't really said or done anything. In fact, if anything, the Fed has downplayed this notion that they would do yield curve control anytime soon. And you've already heard from a few Fed officials just this week alone that they're already starting to talk about, you know, perhaps tapering, believe it or not, by the end of this year. So we'll just have to say that, you know, we bottomed at around 0.5 on the 10-year note in the depths of despair during the winter and spring. And then we've gapped up and got towards, you know, into the 1.18%. We got very close to the 2020 high back in March of 1.18%. Nobody at the Fed really flinched. You only know what's going to bother the Fed once you hit a certain limit, and then they announce something. But I think that from a Fed perspective, the reason why they haven't been unnerved is because they believe we're going to be getting a very big fiscal package. So, you know, we had the $900 billion that got passed already. And Joe Biden said, well, that was a down payment, which was just a glib remark when Mitch McConnell was head of the Senate, and now with Chuck Schumer, it's going to be a reality. So the Fed's sitting back thinking, okay, you know, the risks around our forecasts is that we're going to get a lot of upside growth. No matter how much of the stimulus gets saved or spent, we're going to get more growth by definition. So I don't think they're really unnerved too much by what's happened. Has the stock market really been, you know, roiled by rising bond yields? Well, again, they've taken it in stride for the most part, and it's interesting that everybody starts getting nervous about the stock market, yet there's a lot of sectors that benefit from higher rates, including, by the way, unfunded public sector pension funds and insurance companies. The financials, they tend to benefit from rising rates, and of course, any long duration stock might not benefit as much. But I mean, let's get a grip. You know, a year ago, the 10-year note is just under 2%. We got down to 0.5. Now we're like 1.18. So I'm not. I think that when you start getting the market, what will get the Fed unnerved is if they start to notice that the bond market is getting offside against what their intentions are. And that's what I was writing about as we were getting up. Like, I know people will say, well, you know, 1.15, 1.18, what's the big deal? What's the big deal is the cost to carry is close to zero. The big deal is when you start getting the bond market pricing in the next cycle, a 3% Fed funds rate. That's the sort of thing that might get the Fed. But when the Fed starts seeing the bond market is way overpricing, the timing of what the Fed's going to do, how much it's going to do, that's when they might come in, at least verbally, start to talk bond yields down before they actually do anything. And I think actually we weren't getting far away from that just in the past little while. And then we had that really terrific 10-year note auction yesterday. Mm-hmm. You know, the price, you know, the price talks. We didn't have, you know, 50 basis points ago, we didn't have such a strong 10-year note auction. You get up to like 1.20, 1.2, and you get a strong auction. But I think it's always when people talk about, you know, look at these ridiculously low bond yields. They don't know, they're not looking at it the right way. You have to take a look at it as to where they are carrying against the policy rate. You have the steepest yield curve, and practically, depending on what I measure it, in like a decade. So that's where I'm getting at right now. So I would say that if we were to break, you know, people talking about like, okay, you know, people might say we're going to 3%. Well, we better get some massive inflationary boom, and maybe it's out there somewhere. But I would have to say that if we started getting bond yields up to 1.25, 1.5, you'd find the Fed would find a way to talk people out of a view that's way ahead of where their forecasts are.
Great. Thank you, David. And thank you, Felix. This has just been a far-ranging, fascinating conversation. So many different issues and ideas that both of you have touched on, and just a banquet of food for thought for us to digest over the course of the day and the weeks to come. And David, just on behalf of the Rosenberg research community, thank you so much for reaching out to your really exceptional network of people around the world like Felix and making them available to us for these conversations.
Yeah, Felix, it was wonderful teaming up with you. The hour went by too quick.
Thank you for having me. Thank you for having me. I just want to say one word on bonds. I was pounding the table when it went to 3%, that above 3%, you have to buy it blindly. And last summer, I told my subscribers to get out of bonds, because I do expect bond yields to get close, for 10-year treasuries to get close to 2%, and then come back down again. Whether we will go to new lows or back to the lows or less or above the lows, I do not know. But I think with the declining stock market and with declining slowing economy after the bulge that we get, bond yields will come down again. The downtrend, if you take a pen and a ruler, the downtrend on the 10-year treasuries, the break is at 3%, and that's still far away. And the problems, the real problems, will only begin in the world not just in the stock market, in the world, once we break that trend, believe me.
Yeah.
Then
Wise
thank you
word.
very much for having me. It was a pleasure. Thank you, David.
Thank you,
Hope to
Felix.
see you soon again in person.
Well, I hope that I'm going to be flying over to Zurich as opposed to staying here in Toronto. And I don't care if you have as much snow. I don't care if you have as much snow as we do here. I'm coming over to you.
Okay.
Post inoculation.
Okay.